Hi. Let's learn about the 30-year Treasury. The 30-year Treasury is a U.S. Treasury debt obligation that has a maturity of 30 years. The 30-year Treasury used to be the bellwether U.S. bond, but now most consider the 10-year Treasury to be the benchmark. The U.S. government borrows money from investors by issuing debt securities through its Treasury Department. Debt instruments that can be purchased from the government include Treasury bills, notes, and Treasury inflation-protected securities, TIPS. T-bills are marketable securities issued for terms of less than a year, and Treasury notes are issued with maturities from 2 to 10 years. TIPS are marketable securities whose principal is adjusted by changes in the Consumer Price Index, CPI. When there is inflation, the principal increases. When deflation sets in, the principal decreases. U.S. Treasury securities with longer-term maturities can be purchased as U.S. savings bonds or Treasury bonds. Treasury bonds are long-term debt securities issued with a maturity of 20 years or 30 years from the issue date. These marketable securities pay interest semi-annually, or every 6 months until they mature. At maturity, the investor is paid the face value of the bond. The 30-year Treasury will generally pay a higher interest rate than shorter Treasuries to compensate for the additional risks inherent in the longer maturity. However, when compared to other bonds, Treasuries are relatively safe because they are backed by the U.S. government. The price and interest rate of the 30-year Treasury bond is determined at an auction where it is set at either par, premium, or discount to par. U.S. savings bonds, specifically, Series EE savings bonds, are non-marketable securities that earn interest for 30 years. Interest isn't paid out periodically, interest accumulates, and the investor receives everything when they redeem the savings bond. The bond can be redeemed after 1 year, but if they are sold before 5 years from the purchase date, the investor will lose the last 3 months' interest. Because the U.S. is seen as a very low-risk borrower, many investors see 30-year Treasury interest rates as indicative of the state of the wider bond market. Normally, the interest rate decreases with greater demand for 30-year Treasury securities and rises with lower demand. Here are 3 key takeaways. 1. 30-year Treasuries are bonds issued by the U.S. government and have a maturity of 30 years. 2. Other securities issued by the U.S. government include Treasury bills, notes, and inflation-protected securities, TIPS. 3. 30-year Treasuries pay interest semi-annually until they mature and at maturity pay the face value of the bond. Hope this would help. Thanks for watching.